There is a specific kind of danger in feeling too safe with your money. You lock it away, the balance never drops, and you assume you are protected. For decades, the fixed deposit has been the undisputed choice for risk-free saving. It is the default reflex for any capital you absolutely cannot afford to lose. This chart projects the reality of a standard 5-year fixed deposit. Line 1 shows your guaranteed 6% yield, but line 2 introduces the silent tax, inflation. When everyday costs rise at 6 or 7%, that guaranteed return actually costs you purchasing power. Look closely at this red zone between the lines. Your 100 rupees grew to 105, but the groceries you need now cost 107. You are mathematically moving backward. Relying completely on a fixed deposit means trading growth for the illusion of stability. Over the long term, it guarantees a negative real return. The obvious alternative is the stock market. But if this is capital you absolutely need to protect, like a house down payment or retirement funds, exposing it to 30% market drawdowns is reckless. This leaves you trapped. You need an instrument that dictates exactly when and how much you get paid, just like an FD, but with a yield high enough to actually outpace inflation. The direct bridge between that safety and equity-level yields is the corporate bond. For a long time, these assets were locked behind massive capital requirements, traded only between wealthy institutional investors and mutual funds. Today, the platforms have opened up, giving retail investors a seat at the table. Shifting a portion of your conservative savings into corporate debt is the most precise way to defend your purchasing power without taking on stock market risk. The mechanics are straightforward. When you buy a corporate bond, you bypass the bank entirely and act directly as the lender to a major company. Even highly profitable giants need massive injections of cash. Think of Reliance building out the entire geocellular network. Setting up nationwide infrastructure requires capital that annual revenues alone cannot cover in the short term. The company faces a choice. They could issue new shares to raise that money, but that dilutes the existing owner's control over the business. Instead, they choose to borrow cash from the public. This visual shows how the transaction flows. You provide the capital upfront. In exchange, the company legally binds itself to pay you a specific annual interest percentage. In the bond market, this is called the coupon rate. You receive these interest payments on a strict schedule. When the bond's term ends, say after 3 years, the company returns your entire original loan amount along with the final interest payment. You exchange your upfront cash for a predictable, binding schedule of fixed payments. It operates exactly like a high-powered fixed deposit, but that higher yield demands a trade-off. You are leaving the implicit safety net of a major bank and accepting the explicit risk that a corporation could default on its debt. To manage this exact risk, investors rely on independent rating agencies like CRISIL and ICRA. These auditors tear apart a company's balance sheet to objectively grade their ability to pay you back. This chart breaks down the grading system. At the very top, we have the AAA and AA ratings. These represent highly stable corporations with massive cash reserves. This category is officially labeled investment grade. While yields here sit around 8 to 9%, the statistical probability of these companies failing to pay you back is incredibly close to zero. As you move down the hierarchy to the A and BBB tiers, the yields climb to 10 or 11%. But that extra point comes with noticeable risk. These companies are stable now, but highly sensitive to economic downturns. Everything below this is chunk territory. Single B, C, and D ratings mean the company is actively struggling to survive. The yields might look huge, but the probability of total capital loss is severe. The golden rule of debt is absolute. As safety increases, yield compresses. As a retail investor, you must prioritize a AAA or AA rating over a higher payout. Purchasing these assets is streamlined today. Platforms like GoldenPie allow you to browse and buy bonds directly from the issuer, bypassing the management fees of a debt mutual fund. The only technical requirement is an active demat account, as corporate bonds are held electronically just like your stocks. But there is a barrier to entry. While a bank will open an FD for 5,000 rupees, the corporate bond market requires bulk capital. Minimum investments typically start between 1 to 2 lakh rupees. You also face a severe liquidity constraint. You can break a bank deposit in an emergency for a small penalty fee. With a bond, your capital is strictly locked away for the 3 to 5 year tenure. If you desperately need the cash early, your only option is to sell the bond to another investor on the secondary market. Depending on current interest rates, you might be forced to sell it at a substantial loss. That is the core trade-off. The higher yield you earn from a corporation is the direct premium they pay you for locking away your money and accepting strict illiquidity. Because of those strict constraints, corporate debt is not a universal solution for every rupee you save. To figure out exactly where these fit into your life, let's map out this quadrant. We have your tolerance for risk on the bottom axis and your required returns on the side. If we are talking about your emergency fund, you fall into this bottom left corner. You need absolute liquidity above all else. That money belongs strictly in a standard fixed deposit. But if you have excess capital sitting idle, money you definitively will not touch for 3 years, yet you demand inflation-beating returns, you move up to this top left zone. Corporate bonds are a precision tool meant exclusively for this profile. They maximize the efficiency of capital that can afford to sit entirely undisturbed. You are making a calculated trade. You are trading absolute liquidity and implicit bank guarantees for inflation-beating cash flow and explicit, manageable risk. Do not compromise that math. Risking your entire principal for a fraction of a percent in a lower-rated company is a catastrophic error. Keep the rules strict. Filter exclusively for AAA or AA ratings, and make sure the maturity date aligns exactly with your personal financial timeline. When utilized with discipline, corporate bonds stop being intimidating. They serve as the ultimate defensive strategy to protect your hard-earned savings from the silent tax of inflation.